The shorter trading week is coming to an end, and we've seen some activity in the gold market. Earlier in the week, we saw gold futures go into backwardation. Is it just gold bottoming out, or could the metal be adjusting to the first imminent rate hike? We have Mike McGlone of ETF Securities joining us in studio today. Mike, thanks so much for joining us this Friday.
Thanks for having me back.
So, Mike, it seems that the rate hike will happen in December. Analysts say that this has already been priced into the equation for gold. Yet, if we look at this backwardation story in gold, maybe it's telling us a different story. What are your thoughts?
Well, backwardation in gold is very rare. In fact, what's happened, what it is basically when the front price, the spot price, is higher than the further out futures. Gold's money, and it really should price off the curve in forward rates. As you can see in the screen, the chart shows that trend. Generally, when rates or forward rates are going down, the front part of that curve, as measured by the third future minus the first future, will go down. But it's doing the opposite. And this, right now, what's been happening lately is almost unprecedented for the market to shift deeper in backwardation when the price of forward rates is going up because they're expecting tightening. So it's really odd, it's very strange, and basically backwardation simplistically is a sign of significant demand, physical demand. There's other things involved, but it's basically a sign of real strong demand for gold. Now, what that means, right, what's going to happen, we'll see.
Well, that's what I was going to ask you. Yeah. What could it be telling us? Do you think it's a sign that gold is bottoming out here?
Well, absolutely, but I have to admit, I thought that in July. I thought the market was hitting capitulation.
I appreciate the honesty.
Well, I have to be honest. But this whole process is, I think the market's bottoming. It's just a question of how long it's going to take. And backwardation is definitely a clear sign. This period has been the longest period in history. Now, I just did a 50-day moving average of that curve chart we showed earlier. It's the only time it's ever gone negative. So for the last 50 days. So even you go back to 20 years. So that's a sign of strong demand. And what's happening in the market is, what's changed, I think, since July is the stock market took off, despite the fact the Fed's tightening. It's almost the perfect storm for gold. Question is, how much longer is that going to last? And this is a sign the market's bottoming. It's just a question of how much longer is that going to last. So it's got to cause the most pain, I think, first.
Well, this week, Goldman Sachs came out saying they expect not 1, but 4 rate hikes in 2016. But you say that maybe it's not the best time to start raising rates here, especially with all the mixed U.S. data that we're seeing, especially when looking at retail sales.
Well, that's a dream scenario. A dream scenario for the Fed to be able to tighten 4 times. This effectively implies 100 basis points, and the market's only pricing in maybe 60 basis points, well ahead of what the market's expecting. If that happens, that would be bad for gold. But to me, I view that as a dream. Just think of what it's going to take for that to happen. We need demand pull inflationary forces to really make the Fed want to do that. We need the stock market to keep going up. Because if it goes down like it did in August, they're not going to be tightening, they're going to be easing. And that would be great if it happens. It'd be wonderful. We're all better off. But I think for investors, we have to think the more likely scenario is there's a potential for a misfire here, where the Fed tightens, and these trends that you've seen on the screen with retail sales declining near recessionary levels, the Fed expects that to shift up. And that is a tremendous risk, to expect these trends to shift up despite the fact they're tightening. The last time they tightened, these trends were moving higher. They're still moving down, and retail sales, as far as consumers, is 2/3 of the economy. That is very disconcerting.
Mike McGlone of ETF Securities, thanks so much for stopping by the studio.
Thanks for having me.
And thanks for watching this edition of Kitco's Gold Report. We'll see you next week.